The trading platform Tradingview have just introduced this completely new type of chart called high and low. It's a different and interesting concept that has the potential to assist a lot of traders who use price action to analyze their charts in an entirely new way. Now, the goal is for this new chart to create more accurate trade entries and exits, which is of course something everyone is looking for. So in today's video, I'm going to break down this new chart and show you how to read the high and low chart, whilst also sharing with you some of my best price action techniques that can be applied to it. Okay, let's jump into the new chart. We're currently looking at Ethereum USD on a 15-minute time frame, but before we apply the high and low charts, let's have a look at the regular Japanese candlesticks you will most likely be used to. And the main problem with these Japanese candlesticks is that it can be really hard to read them as a beginner. The candlesticks have patterns to them that you need to learn, and there's no numbers or exact points of reference. Another problem is the colors of the Japanese candlesticks might give you a false feeling of where the market is heading. They only work in trending conditions, and when the market is not trending, the bars can be the opposite color of what's actually happening. If you look here, we see that the price action is trending in a bullish direction. The candlesticks are mainly green, so that's correct. And when the market starts moving in the opposite direction, a bearish direction, they turn red. But as soon as there is any chopping and changing in the market trend, which is also called a market that's not trending, the bars are literally completely random, and they don't reflect that exact point in time at all. This is of course very unhelpful. Now, as you can tell, an alternative type of chart that would solve these problems would be amazing, and conveniently, Tradingview have finally introduced it. So to apply it to the chart, we will navigate up to the candles tab at the top of your normal trading chart, then click on the option high and low. Now, as you can see straight away, the chart looks completely different. There are no intimidating colors, lines or bars, and there is far less noise going on. On top of this, you can completely customize the look of the chart to suit you by double clicking on it. You can change the color of the body borders and labels, but I like to keep mine white and green. Also, if we zoom in here, you can see that each candlestick has a number which displays the high and low price that happened during this time period. Of course, each bar represents a period of time that your chart is on. So I have this chart on a 15-minute time frame, which means each bar is representing 15 minutes. Another noticeable change is there are no colors now. Some may see this as annoying, but honestly this is probably the biggest advantage because you literally trade in a neutral state of mind, as you're not being influenced by red and green colors that are probably incorrect anyway. When you first start using the chart, it may take you a while to get used to it, as you're not used to seeing the open and closes, but once you get used to it, you'll start analyzing the price action like an experienced trader. Alright, I think it's time to actually understand how to read these candlesticks. So when the high and low of the recent candlestick is higher than the high and low of the previous candlestick, that means the market has a bullish momentum. This means that the buyers are now controlling the market. However, when the low and high of recent candlesticks is lower than the low and high of previous candlesticks, the market has a bearish momentum. This means that now the sellers are controlling the market. Now, as you can see, this is far easier to read than regular bars, as you don't have any complicated candlestick patterns that you need to remember. With this chart, there are actually only 4 patterns, and now I'm going to show you them. So the first candlestick formation is the bullish candlestick, which has a higher high and a higher low compared to the previous candlestick. The next formation is the bearish candlestick, and these have a lower high and lower lows compared to the previous one. The third type is the inside candlestick, and it has a lower high and a higher low compared to the previous. And finally, the last formation is the engulfing candlestick. This type of candlestick has a higher high and a lower low compared to the previous bar. So now hopefully you can see these 4 formations are super easy, and they're all related to one thing, which is highs and lows. Now, how are we actually going to trade with this type of chart? Well, before I teach you the strategy, it's important you grasp the concept of a few quick rules first. Now, the first rule is when the price action forms consecutive bullish candles, the market is in an uptrend. Second, when the price action forms consecutive bearish candlesticks, this is a sign that the market is in a downtrend. Next, a strong bullish candlestick confirms the start of an upswing, and at the same time, it indicates the end of the downswing. This is a pretty important rule to remember. And lastly, a bearish candlestick indicates the end of an upswing and the start of a downswing. And for this, the inside candlesticks are usually neutral bars, and if they are, they won't affect the overall trend direction. However, engulfing candlesticks introduce an uncertainty, but if these candlesticks are formed after a major upswing or a downswing, the price action is more likely to continue to move in the same direction. Now, when using this chart, there are lots of price action strategies that you can use. For example, you could start out by just using the easiest one. For this strategy, you just need to find the major levels of support or resistance. And taking a look at this chart, we can see here the major points of resistance is $1,400, and the price action bounced off it a couple of times. And to confirm the entry, you just need to wait for a few consecutive bearish candlesticks. And here we can see the price action is making lower highs and lower lows, so we can place our stop loss slightly above the level of resistance. And for our take profit target, we're going to set it between 1.5 and 2 times the risk. Obviously, you would start at 1.5 times, and as you got more confident with your ability to trade using this strategy, increase it. Now, as you can see, the market is immediately going in our favor and it hits our take profit target. Another strategy that you could use is a pullback strategy. As you can see here, we have a 50 and a 200 EMA line. So to enter a long trade, we're going to be waiting for the 50 EMA to be crossed above the 200 EMA. Then we're going to want to see the price action pull back into the 50 EMA, and as soon as the engulfing candlestick is formed, we can place our long entry. For this pullback strategy, the exact opposite will be done for a short trade. First, we need the 50 EMA to cross below the 200 EMA, and then the price action needs to pull back into the 50 EMA, quickly forming an engulfing candlestick. Now we can see this candlestick has higher highs and a lower low, so we can enter our short trade. If you want an even higher rate of success, you could use a confirmation indicator. Although, whilst this indicator will stomp out pretty much every losing trade, it will also stomp out a lot of winning trades, meaning you will get very few entries. And with that, this video is complete. I hope you got value out of it, and if you did, I'd appreciate it if you guys could leave a thumbs up on the video and subscribe to the channel. As always, if you have any questions or have a strategy you want me to explain in a future video, comment it down below.